Welcome, my name's Gareth Hector. I'm Head of Marketing here at Westwood Global Energy Group. I recognise quite a few of you from the room from last year, so I'd like to welcome you back to our annual APAC Offshore Energy Services event. We're going to try and keep to time today as usual, see how we go. A couple of housekeeping items as usual. If you wouldn't mind having your phones to silent, happy for you to share that you're here on social media. Questions will always come up about will the deck be available. As you can see, we are recording the session, so everything will be available to you afterwards. So if you miss anything, scribbling furious notes, don't worry, you'll have the chance to look back over it. For today, I'm sure you're all aware of the agenda, but a very quick run through. First session, we have Tom and David Linden, and then Ruth Chen covering a macro overview, energy transition, offshore wind. Got a short break, 20 minutes. Quick coffee break, and then back in for 3 o'clock, where Chen Wei will speak to offshore marine, Paul for rigs, and then we'll get everyone back up for a Q&A. On the Q&A, there are some forms on the tables with a QR code. I know it's not always comfortable putting your hand up and asking questions, so if you want to scan the QR code, you can submit questions and we'll just take them from the site that you submit them to. And David does also have a question for you all as well, which will be done via the QR code. Once we finish the session, the Q&A, then we'll have a couple of hours for networking, some more drinks, some more food, and all of the Westwood team will be around to answer any questions on anything that you have seen today. I won't go through these one by one. I'm sure you're familiar with quite a few people that are going to come up and speak to you today. But suffice to say, we've got our key analysts here to speak to all of the core areas that we'll be looking at this afternoon. In addition, I've obviously got myself, a younger version of myself, I think. Yeah, a 10-year younger version of myself on the screen. Emma Looms, our head of sales, is over from the UK as well, and of course Leslie. Where are you, Leslie? Awesome. So Leslie's around somewhere. He'll be in shortly, but Leslie's our BD director here in Singapore as well. And we have a fantastic team who helped pull this together, who you'll have all met as you come in. To keep to time, I won't go through this in detail. I have a couple of minutes, but if you don't know what we do, please come and speak to us. We are a leading research and consulting firm. We work globally across the upstream energy space, and you may have come across us in previous guises before we became Westwood, be that Douglas Westwood or Richmond or so forth. But of course, as the energy landscape changes, so do we. We're trying to move in step with you and your businesses and deliver content such as today, which hopefully when you leave, and I'll find out from your feedback forms, has been of some value to you. Again, I won't go through these in detail, but it's just to give you an idea of the sectors we cover. New energies, which David and Ruth will speak to, for climate emissions, wind, CCS, which I know is going to be touched on today, and hydrogen, which excitingly we have a new product coming out next year for. And typically for offshore energy services, again, which we'll be covering today, all except really subsea. That's what's on your tables. If you could mind taking a couple of minutes to give us your feedback, be greatly appreciated. A couple of product slides, if you're not familiar. We have a copy of the Q1 Offshore Navigator, if anyone's interested in having a look through, which we produce in association and partnership with Braemar. And then a couple of key products that you'll hear quite a lot on in terms of where the analysis comes from. Usual disclaimer on what you're going to hear. And that's it from me. As I say, any questions at the coffee break or at reception afterwards, please just grab one of us. We've all got blue badges on, and we've got plenty of laptops around, so if you want to have a look at some of the data, by all means, let's do that. So, I'm going to hand over to Tom, and then we will see you at coffee break. Tom.
Okie dokie, good afternoon, ladies and gentlemen. Great to see so many familiar faces here and some new faces too. My name's Tom Payne. I'm Head of Commercial Advisory Services for Westwood as a group, but I also have the responsibility for APAC, covering the kind of breadth of our service capability. My role today is to provide a bit of context, or a bit of scene setting. I'm going to talk quite broadly around some of the key themes that we see shaping the offshore energy services market today, and over the next 5, 6, 7 years as well. A lot of what I'm going to be talking about, and a lot of what my colleagues are going to be talking about, is focusing on the outlook. It's a lot of what we do. It's to provide a sense of our expectations from our data about how these markets are going to trend. And a bit of a spoiler alert, it's all very positive, which is nice to say. We have lots of charts pointing in the right direction, which is always good. But I think before we kind of start talking about what the future may or may not hold, it's probably worth just recapping what the last few years have looked like as well. We've been on quite a journey in the energy industry over the past 2-3 years, kind of coming out of the pandemic. And when we think about the energy industry, it's always useful to think of the trilemma, the triangle as a bit of a framework there. Now, don't worry, I don't have a slide on the energy trilemma. I'm not going to go into too much detail. It's been beaten to death to some extent. But really, what we've seen over the last 3 years is a kind of a full lap of that triangle. And that triangle dictates that an energy system needs to be secure, sustainable, and affordable. And what we've seen since 2020 is we've seen a huge shift in the consensus view towards sustainability during the years of the pandemic. We saw the real rise of the energy transition really in the foremost front of our minds for any business in oil and gas or energy at large. And as we came out of the pandemic, we saw another black swan event, 2 black swan events in 3 years. We saw the Russian invasion of Ukraine. And suddenly we started shifting our thinking to security. Where do we get our resources from? That suddenly became such an important factor. Not just sustainability, but the security of that supply. Do we have to rethink our alliances, our old friendships, our old trading patterns? And now most recently, with the cost of living crisis, affordability really in the forefront of everyone's mind right now. Costs are getting higher. We're going to talk an awful lot about costs today. It's one of the key themes of the presentation. It kind of ties everything together. But really the key point is there is a huge amount of uncertainty and a lot of volatility that's underpinning the underlying growth in the offshore energy services sector. So what does that mean for oil and gas? Well, if you were talking to people 3 years ago, there was a consensus view that oil's peaked. We don't need any more oil, no more exploration. Let's start limiting development. We need to race to net zero. There has been a bit of a realignment, let's say, in the general consensus thinking that perhaps the energy transition is a transition. It's not a light switch, and we're still going to require oil and gas for the foreseeable future. So with that in mind, here's our view on what's happening to oil and gas supply all the way to 2030, which is where we're pretty confident with our visibility based on projects and future demand expectations. And what we have here on the first chart, this is liquids. Liquid supply broken out by region, and the key takeaway globally is that we expect an incremental supply of about 4.5 million barrels from 2022, which gets us to a peak of about 106 million barrels a day. That's quite a vanilla take, to be honest, when you look at what most analysts are projecting, but we expect the market to effectively plateau at around that 105, 106 million barrels a day, and then as we get more structural shifts in investment, we will start to see that decline. But the time and duration of that decline, still a lot of certainty and very much up for debate. When we look regionally around the contribution of that incremental supply, it gets very interesting, I guess, in our opinion at least. We certainly see a couple of losers when it comes to share of liquid supply, and we see some very clear winners. A key underlying theme when we talk about market growth in oil and gas is that we are seeing huge amounts of investment we'll get into, but it's very much localized around the shallow water Arab Gulf. Huge amounts of news from Aramco, from QE, from ADNOC about investment plans that they're making. And in Latin America, where Petrobras is being joined by Guyana and longer term Suriname as well. So we expect to see just under 4 million barrels of incremental supply pretty much from the GCC region, and of just over 2 million barrels a day of incremental supply from LATAM. And offsetting that is a decline in Western Europe driven by the UK. Huge uncertainty in the UK right now, a shift in government could see a faster decline in the oil and gas sector, but that is a market that's very much on the downward trend right now. And Russia. Now, the Russian market's interesting, of course. Russian supply severely impacted by the Ukraine crisis, and a general consensus now that they will be unable to bring their liquids production back to its heydays in 2019, when it was about 11 million barrels a day. So that's the general takeaways in the oil markets. When we think about gas, it's somewhat of a similar story, but we are seeing the major gains coming from the Middle East again, driven primarily by Qatar, but also Saudi Arabia with the huge Jafurah development, and North America, which has really been ramping up its LNG export capacity. These two countries really filling the gap that's been left behind by Russia, where we expect gas supply to fall by about 4 million barrels a day to the period to 2030. So we do suddenly see a shift in where oil and gas is coming from, and that harks back to that security question in the trilemma. So again, the key takeaways here is there will be a requirement for more oil and gas going forward in our view, and it's going to be increasingly localized in some of these core export markets of the Middle East, LATAM, and North America. So that's all good and well, but when we think about energy services, we think about rigs, we think about subsea, FPSOs, we think about vessels, oil price continues to be our key indicator. It's what we look to when we think about levels of activity, when we think about profitability. What do we think about oil prices? Well, when we think about oil prices, we have a very simplistic way of forecasting or projecting oil prices, if you will. We look historically at how the market has performed, and we look at key events to try to give us a sense of where we think the range is going to be over the next 3 years. Now, what I've done here is since 2017, I've broken out some key periods. We're all very aware that in 2014, 2015, the oil price crashed. We're very aware of the reasons for that, the increase in US shale production, and a massive oversupply of liquids. In 2017, there was a key moment where the OPEC Plus bloc decided enough was enough, and they were going to start to intervene very heavily in the market, taking barrels away in an attempt to balance supply and demand and to rally prices. And I've shaded the key periods of OPEC intervention in red here, and you can see that when they have been intervening in the market, prices have typically trended in this $70 to $85 kind of groove. Now, I already mentioned two key black swan events, the pandemic, COVID, which saw prices crash at unprecedented levels. We saw WTI go negative for the first time in its history. We saw a very sharp reaction by OPEC to bring prices back up. Then we were hit by the second black swan event, the Russia-Ukraine crisis, which saw crude prices spike above $120 a barrel. We saw a similar reaction, and now we have prices settling again in this 80 to 85 kind of dollar groove or window, and that is really the range that we expect to see going forward. So when you see projections from us on oil and gas activity, it's predicated upon an $80 to $85 structural market. And one of the key reasons that we think that that is something that we can have some confidence in is that also happens to be Saudi Arabia's fiscal break-even for 2024. So that is the oil price that they need to balance their national budget. And we, of course, we're all very aware that they will intervene in the market to get the prices where they need them to be. Of course, there are always a number of wildcards that can impact that. OPEC's commitment to those interventions, faltering economics, US crude capital discipline, and when we think about the bear factors as well, concerns over China's demand, although that has been quite robust in recent quarters, and as well, so maybe some of the more key kind of bear factors that could pull down prices or challenge OPEC's resolve is the increase in Iranian output. So we have seen the US administration now starting to maybe move back on those sanctions and allow more Iranian liquids, typically NGLs, into the market. But also the US NGL story is critical. We've mentioned before that a lot of the growth in gas is coming from the North American shale market, so that's the Haynesville and other gas-heavy shale basins. But a byproduct of gas drilling are NGLs. These are the liquids that come as part of the gas drilling process, and we're already seeing a significant ramping up in those liquids coming from those shale basins, which will be adding to supply going forward as well. So what does this mean for investment in oil and gas? This chart here plots offshore EPC investments. So this is effectively the money we spend on new offshore oil and gas projects. In shallow water and deep water, this is fixed platforms, floating platforms, pipelines, subsea, and all that kind of infrastructure. And the key takeaway here really is in 2023 and 2024, we're going to see unprecedented levels of investment. We're going to spend more money on new offshore oil and gas projects than ever before in 23 and 24. And that's after several years of pretty poor performance. We saw a record low in 2020, but again, we're going to see that record level in 23, 24, even compared to 13 and 14. And when we think about the shopping list, some of the key numbers there, we're expecting 33 floating production platforms, the majority of those going to Latin America, so that's 12 of those going to Latin America, and we expect a whopping 377 fixed facilities to be ordered in 23 to 24. And again, the vast majority of those going into the shallow water Middle East, and a huge amount of that number has already been awarded, is already under construction, and at some point very soon is going to need to be installed and commissioned and supported by a host of rigs and offshore vessels. Pipelines as well, we expect around 15,000 kilometers of pipelines to be ordered over the next couple of years, and APAC, the key market for that. So whilst we're going to be talking a lot around the Middle East and a lot around Latin America, APAC remains a very large market for offshore energy services. We are going to continue to see significant investment in this region as well. You can see that breakout, this light blue in Asia. It's certainly expect to see a significant ramp up, almost a doubling in 23 and 24 with regards to investment. A bit of a glimpse into the future here. We're looking at high impact exploration, which gives us a bit of sense of where the industry is trending slightly longer term. Where are we finding resources at the moment? And where are the super majors and other major oil and gas companies targeting regionally to discover and unlock more resources? This first chart here, it is showing the number of high impact offshore exploration wells. When we talk about high impact, we mean we're targeting more than 100 million barrels of resource, so a significant discovery. And you can see that we've seen a ramp up in exploration drilling in 22, and we expect that level to be sustained this year and to be sustained next year as well. But when we look at Asia Pacific in particular, whilst it has accounted roughly for about 15-20% of overall activity levels, it's actually the region that's going to see the biggest ramp up next year. It's the region where we expect to see exploration spike more than any other region in the world. And you could argue that a lot of that is around Eni's recent huge discovery at Geng North. That certainly has a lot of people talking. It's around 5 trillion cubic feet of gas resource, which is pretty significant. But perhaps more importantly is its location next to the IDD project, which Eni also bought into recently. Huge amounts of stranded gas currently exists in the Asia-Pacific region. And the discovery of this magnitude in this location. So looking at oil and gas in context, but of course, when we're talking about offshore energy services, we use that term very deliberately because everybody in this room, maybe 10 years ago, your business was almost 100% oil and gas. We're certainly seeing our businesses migrate towards new energy, towards renewables. That is just the way of the world. The way the world is evolving. And what we've done here is map that offshore EPC investment, so the offshore oil and gas that we saw before in dark blue, but then we've layered on offshore renewables, offshore wind fundamentally. That's effectively what this is. And you can see a very rapid transition here. Of course, oil and gas was the dominant market over the past 5 years, accounting for 68% of spend in the 14 to 17 period. But as we move into the next 5 years, offshore wind will really come into its own and dominate that spending, with oil and gas accounting for only 38% of EPC investment over the next 5 years, and that's just under $1 trillion. So we're expecting a huge ramp up in investment, but we're expecting an even faster rate of growth in offshore renewables and offshore power, effectively interconnectors and power cables, relative to what we're already seeing in oil and gas. So what's the takeaway here? For any business, of course, critical to have a developed and considerate energy transition strategy. There is huge opportunity in the offshore wind market, and we're lucky to have some real experts who are going to talk in more detail. We have my colleagues David and Ruth who will talk through the size of that opportunity. But a key, and it's also critical to not walk blindly into these markets, to understand the commercial challenges that exist. It's not just going after volume. It's not just taking what we know from oil and gas and imposing that onto a new customer base. It's understanding how these markets work. It's understanding the risk involved of entering these particular markets in order to really unlock the value and potential that they have. So a couple more slides from me just in terms of setting the scene. One of the key themes that we're looking at now is cost escalation. Now, you've already seen a lot of growth, a lot of very positive slides. You're going to see a lot more positive slides. You're going to see positive slides in wind, in marine, and in the rig market. But it's our job as market analysts that when times are tough, to look for the bright spots. But when times are good, it's also our job to start to urge a bit of caution. Where can things go wrong? Where are the lessons that we've learned in the market? So something that we're certainly looking at already is the rate of cost escalation. Now, we've all gone through a very terrible decade, and we really deserve a period to kind of pat ourselves on the back and to really kind of think, okay, and to enjoy increased pricing, increased utilization, and increased cash flows. We certainly deserve that after what we've kind of been through as an industry, but that rate of growth is something that's starting to cause some alarm to us. What we've mapped here are two cost indices. So we have a deep water development indice, this is for oil and gas, and a shallow water indice. And we can see realistically in 2023, our view is that we are close to what costs were in 2014. And by the time we get to 2024, we're going to effectively exceed costs. So the cost is going to have completely come full circle, and the cost for a rig, the cost for an FPSO, the cost for a subsea tree, the cost for an anchor handler, these costs are effectively going to be aligned to what we were paying at the height of the market in 2013 and 2014. But the flip side to this is whilst we're seeing that increase in demand, a similar if not more demand for the next couple of years, the capacity in the market has shrunk. Now, this varies from segment to segment from around 20 to 40%, but all segments, again, construction, fabrication, marines, rigs, these capacities have shrunk 20 to 40%. So you can see where I'm going with this. We have this expectation of demand growth, but we do not have the same capacity as we did before to satisfy that. And what does that mean? It means we're going to get more utilization, higher utilization, shortages of equipment, shortages of labor and manpower, and of course, increased pricing that we've seen today. And one of the key themes, I think, of last year was, we can see it coming, how do we expand capacity? Well, very challenging. In the first instance, for many of the service contractors, there's not even a motivation to do this. If we think about the drillship market, we still have quite a lot of drillships in Korean yards that could come into service the market. But why rush? Why not just enjoy the high day rates, enjoy the high utilization right now? So on the service contractor part, certainly some people are looking to try and expand their capability and their capacity, but for many, they're just enjoying the good times while they last. But as well, even the access to capital and the ability to expand capacity is very, very challenging. And we'll hear more about this from a number of our speakers. But if you're in the oil and gas market, trying to raise funds for a new build, as many people in this room would attest to, almost impossible. Unless you have a 10-year contract from a super major or a major national oil company, you're simply not going to get funding to expand your capacity. So the ability for the industry to expand capacity, to grow with the expected demand, simply doesn't exist in the current structure. Maybe it will exist in the next 2 years, but at the moment, we're very much stuck in a situation of demand growth, which is already paid for, and a supply and capacity, which is limited and will not grow further. But the key question here is, that's all good and well, but how high can the prices climb? And is there a potential ceiling on those prices? And this is where things get a bit divisive. We're lucky enough to work with a very wide range of clients. We do strategic consulting, we do sell-side consulting, we do buy-side consulting. And there's very different questions being asked for those three types of processes. We have certain clients in marine and rigs who think rates will just continue to grow. For the reasons I outlined, there's no new capacity, there's demand, rates just have to grow. We have others who urge caution. They think, okay, well, we've seen this before. If the rates grow too high, will we see a reaction? Will we see a deterioration in the rates that comes afterwards? The way that we think about it, again, trying to simplify it, is when we think about day rates, somebody has to pay that money. This money is not magical. There's not a magical endless pot of money to pay for this increase in rates. It has to come from somewhere. And it comes from the cash flows from the oil and gas companies fundamentally. That's what pays for everything. And then when we think about cash flows from oil and gas companies, it's production, which we know is robust and going to grow, and it's oil prices. Those are the two fundamental levers that determine cash flows. So what we need in order to satisfy growing pricing comfortably is we need more production and we need higher commodity prices. Now, we've already talked in the second slide that we believe oil prices will be in a $80 to $85 a barrel structure. And we believe that pricing is already at 2014 levels, but as you can see here, When we had those 2014 pricing levels, we were in a $100 a barrel a day structure. We had higher cash flows. And for those of you who remember 2014, even in the latter quarters of that year, oil and gas companies were already complaining in a plus $100 a barrel environment that their cash flows were diminishing due to industry cost inflation. There are a number of metrics you can use. You can use cash return on cash invested, or you can simply look at cash flow per barrel produced as well. These are metrics we can look at from the E&Ps. And whilst we're not seeing the stress in that market right now, certainly something that's catching our attention is, as these guys continue to post their cash flows, are we going to see a situation where their cash flows start to diminish on a per barrel basis? Are they going to start to feel the stress of escalating costs and costs returning to 2013 to 2014 levels? And then what does that mean for the sector? Well, for the next 12 to 24 months, not much. They're going to have to kind of live with it because we're in a situation where we've already paid for these projects. As I mentioned, if we look at the Middle East market, all of these fixed platforms, they're being built in the yards right now. They have to be hooked up and commissioned. There's no real choice. But beyond that period, when we start thinking about 26 to 27, are we going to start to see stress in the market as a function of this? And the question is perhaps. We are already seeing right now cancellations and deferments in the oil and gas sector. Now, some of these are more political or geopolitical, but a lot of them are actually economics. An example in this part of the world would be Limberjung. It's a kind of a poster boy for what's happening right now. This is a project that effectively got sanctioned. Everything was agreed. But then 18 months after sanction, the project team had to go and source an FPSO. And the quotes they were getting for the FPSO were effectively triple what they had budgeted, from what we understand. And as a function of that, this project is now almost in limbo, if you dismiss the pun. But this is endemic of what is happening in the sector at whole. The rapid rise in cost inflation is forcing people to go back to the drawing board. It's causing cancellations, causing deferments. And as that happens, what you may see post the current surge, post-25, is a slowdown in activity. The same projects, but happening with less intensity. And what does that do? It reduces rig activity, it reduces marine activity, reduces utilization, and the market self-corrects. So whilst we're certainly having a great time right now, and in our view, the next 18 to 24 months will continue to be very buoyant, it's always worth considering longer-term strategies, making sure we have a robust ET strategy, that we are diversifying the way that the world is diversifying, but also that we're not getting carried away with current pricing growth. We are interacting with our clients, and we're making sure that we are communicating, collaborating with them to make sure that we have long-term relationships with them. And I'm going to leave you with that, with those thoughts, and I'm going to pass over to my colleague, David. Thank you very much.
Just while David's making his way up, I see a few questions coming in via the app already. We are going to take those at the end unless we get a bit of extra time at the end of the session. Just a note, you can upvote questions, so if you'd like to see one answered over another, just go on and give it the thumbs up. David.
Thank you very much. Hello, everybody. I'm David Linden, Head of Energy Transition at Westwood. I don't think I've had the pleasure to speak to most of you, so it's nice to be up here and look forward to, well, hopefully some of your questions later on. As Tom said, I guess part of the reason I'm standing here is we are helping our clients really with their energy transition strategies, which is kind of a core part of how you need to think about the long-term part of your business. The offshore sector in itself is transitioning, and I know that Tom mentioned the offshore wind or the renewable power side of things, but the way I also think about it is there is essentially a change happening across the value chain in many different ways. And here's just a few examples of the ways that we're looking at it as well. There's carbon capture and storage to think about. There's hydrogen production, whether it's offshore or there's storage offshore or there's production of power offshore to bring onshore to create hydrogen. There's decarbonization of that supply chain that you need to be thinking about. There's platform decarbonization using things like floating wind. There's deep sea mining, even if you want to go as far as that. So there's actually a whole range of things to think about and consider when you're thinking about what does energy transition really mean for the offshore sector. And that's the kind of thing that we help our clients with. Now, in my mind, that is a great opportunity set for people. But the question really is, just considering what Tom was talking about there, the changing trilemma, the changes to where the oil price currently sits, where the market dynamics generally are moving. How do you consider that impacting your business? Are you seeing more or are you seeing fewer opportunities? So I'd like to pose that question first, and this is where Gareth had originally asked if you could use either your phone. There we go. More opportunities. We can stop there. That's fine. We don't have to get any further. But please do input your views here, because it'll be useful to see just what people do see. Because obviously the market has come to a point, really a bit of a tipping point in some respects, or is there a pause happening? So it'd be good to just get some views. I'm going to pause for 30 seconds. I'll make it an embarrassing pause to make sure you get your phones out and vote, please. Perfect. Perfect. Excellent. Okay, we'll keep going. Keep doing it. I don't want to make you too embarrassed. So what I wanted to touch on the point today is essentially also what Tom said was really there, the energy transition side of businesses is different to what we've all been used to in the oil and gas side, right? There are different commercial drivers. There are different commercial markets and rationales to how those markets are evolving. So I wanted to touch on, first of all, the offshore wind side of things. It is by far the biggest spend going forward. It is going to be the dominant spend on the offshore space in that sense. So just really taking a bit of a look at that side of things is going to be important, where that market is. My colleague Ruth later on will take much more of a deep dive into some of that, but I'll try and give you a kind of a bit of an overview of that. And then afterwards, I'll also spend a little bit of time on CCS as well. Why CCS? Well, CCS kind of represents a little bit of all of the different other things that you need to be looking at, because it's not quite there yet, but it's coming. What does that look like? And I'll just focus a little bit on Asia and give you a bit of a European context as well. But that's kind of a case study maybe for you, just to see how things are going. But good thing is everyone sees more opportunities so far, or the majority of people. So in a democratic vote, we are definitely seeing more opportunities. So thank you for that, guys. Okay, so offshore wind. Well, it's not necessarily been a fun year for offshore wind in some respects. There were things bubbling up towards the end of last year, which were indicating there might be some issues in the market, so cost inflation, delays, changes to regulations, delays in auctions, those sorts of things. But they've really, very clearly, towards sort of the end of the second quarter and certainly through the second half of this year, have really come in as a series of delays and cancellations to projects. So we're looking at something like 12.5 gigawatts or 35 billion of capex that we're already seeing is delayed from this year. And that's obviously publicly announced delays. There are other things going on that we don't have full line of sight on, but that's what we're seeing. And this is majority US, a bit of UK, Europe. We're not seeing it publicly, at least in Asia yet, but don't forget it's a much smaller market and there are things moving at a different pace. But what we're seeing is, I would say, quite a scary story of things really being pushed out significantly. And this is often newer markets, ambitious projects, so think of things like floating wind as well, etc., which essentially were going to be the leading edge of where the industry was going. We haven't seen what we call conventional projects being impacted just yet. But this also gives you an indicator that the leading edge of the industry is struggling. So what we've decided to try and do as Westwood is try and say, okay, look, really what this industry is starting to get to is into a territory of risk. So what our clients need to better understand is the demand side of the picture that little bit better. So if I'm going to be serving this industry, how confident can I be about what's going on and where it's evolving? So we developed something called Project Certainty Assessment, and we've applied that to all our pipeline, and that's something we regularly assess our pipeline with, really to help people understand the risk profile of that pipeline going forward. And it's essentially telling you what the current likelihood is of individual projects going forward. So we go project by project, and we assess it by 10 different criteria, everything from how experienced are the developers are involved, how far down the permitting process are they, have they got a lease, have they got subsidy support, PPAs, those sorts of things, so power purchase agreement in place. And we use that to assess that. And what you can kind of see is different levels of risk. So the risk is the highest risk, essentially, and the sanctioned is the lowest risk because essentially they've already taken FID. And so in this way, you get a real sense of what's going on. And we're expecting something like 230 or so gigawatts to take FID, to come online, and take FID by the end of the year. And around sort of 15% of that is in a high-risk category. For Asia specifically, note that this is going up to 9 gigawatts, not 90 gigawatts, so it's a different scale. But Asia as a market is, at the moment, just because of its newness as such, we put it in those words, it's just a riskier market at this stage, right? There are either projects that have been dreamt up but don't have a lease, or there are leases that don't yet have projects. And there's if you're in that state right now, that essentially tells you you're going to struggle to make some of these projects come to fruition in such a short period of time. So a lot of Asia is still struggling with that because you've got very immature markets still. You've got markets like South Korea, you've got markets like Japan, etc., which are really trying to break through, but they're just not quite there yet. Europe as such has some of the benefit of obviously longevity and growth and change in regulation and more mature developers. But essentially, if you've got a newer market like this, you do end up having a higher risk profile ahead of you. So, and that's about 34% or so of capacity going forward that is risked. But what's interesting is your customer. It's not just the region you're in, it's your customer as well. And we've done this on a global scale, and you can cut this data in so many different ways to sort of suit your needs and try and understand how the world looks. But while Ørsted's getting a lot of flack and is essentially being downgraded and impairments in the US, actually, it's got a pretty sensible and strong pipeline for the next decade, right? There's only a small portion of its capacity which you wouldn't necessarily see is going to go forward or have a bit of an issue. As you can imagine, that's somewhere in the US. Well, a lot of other for all these different developers, these are in markets such as the UK, Netherlands, and other more mature markets, and they've got leases, PPAs, and subsidies in place. So actually your top 10 global project owners, and I've excluded mainland China from here, but those are in generally a more comfortable position, as you would expect. But there is a very long tail as well. But this kind of data is useful just for you to try and get a real sense of, well, how risky is my client, how risky is my customer? And if you were to sort of pick a few different areas, in here on the risk side of things are places like Sweden. Sweden is flip-flopping back and forwards with the type of energy it wants to produce, whether it wants to move forward with its offshore wind plans or not. Places like Italy, which have got almost a 90 gigawatt pipeline, which looks fantastic, but essentially there is no subsidy in place whatsoever. So no project's going to move forward until that's in place. Okay, so that was offshore wind. As I said, my colleague Ruth will do a lot more on that just straight after me. So if you're keen for more details, I'm sure she can give you some of that. As I said, I wanted to talk a little bit about carbon storage, or carbon capture and storage, because it's been one of those things that has often been talked about. Yes, it's coming, it'll be something we need to do, and if you look at any kind of long-term energy transition outlook, it'll always be, we have this many megatons or so that we need to store by X year. It almost doesn't matter in some respects, but they're always big numbers, and you're like, well, this industry hasn't gone anywhere. Well, the reality is that it's now going somewhere. So I sit in London. Certainly if I look out what's been happening in my region, certainly there in the UK and the whole of Northwest Europe, things have progressed significantly. The Northern Lights project over in Norway is already essentially moving ahead, is taken FID and is in the construction phase, and has already signed commercial contracts for the delivery of CO2 from different parts of Europe. I think just yesterday, the Porthos project in the Netherlands also took FID. So these projects are now taking FID. They're going to get all the different bits of kit together, and they're going to move ahead. Here in Asia, so what you've got on this chart, I should explain just properly, is you've got different projects that we've identified here, and these are the storage projects, I appreciate. So I'm focusing on the offshore side of things. There are a few onshore projects as well, so these are the offshore projects. But these are all the different projects we've identified in the region. With the green ones, apologies if you're colorblind, but let's say the lighter ones on the starting on the left-hand side, that color, those are the ones that we see are what we're calling post-concept projects. So these are the ones that are moving further ahead, are faster, and have had some activity, while the early concept projects are ones that have got a much longer timeline in that sense. And initially, when you look at this, Australia is essentially the most dominant market here. Australia's had a long history of looking at this. You've had the Gorgon project there, which has been going for a few years now. It's had a few teething issues, should we say, but it's a proven CCS project. And the sort of oil and gas legacy of Australia essentially allows it to carry through and continue to try and develop more carbon storage projects. What helps drive it as well, though, is it's using both the licensing rounds that the government's putting forward. It has a carbon price, which is very low compared to Europe, but it incentivizes some activity. But it's also the opportunity set that Australia sees of taking CO2 essentially from the rest of Asia and transporting it and storing it underground in its region. Initially, though, a lot of projects are going to be based not on post-combustion. It's going to be around gas processing, those sorts of things. Those are far cheaper to do initially rather than the kind of more expensive post-combustion developments you're seeing maybe in kind of decarbonization of industry in parts of Europe. The incentives mechanism in this part of the world just simply isn't quite there yet. So it's going to take a lot more government effort to make that happen. Other parts of the region are certainly also moving forward. So interestingly, Japan and others typically said that we don't have any storage, and so we need to move forward into looking at other regions. Actually has started its own research and is thinking about having its own carbon storage sites ready by 2030, which is a little ambitious, to be fair, but at least the government is very interested in making that happen. And of course, many of you, if you are looking at the CCS space, would be looking at places like Malaysia, where you've got the Kasawari project that is also moving forward. So the question, of course, is why are we bothering to talk about this? Well, essentially, it's an opportunity in a sense of, so we already include, for example, CCS in both our rig logics and our subsea logic market intelligence solutions, because it's almost a very clear crossover between what's happening from the oil and gas industry very clearly into the CCS industry. And so what we've tried to do here on this chart is just highlight a little bit, okay, so if you consider those projects that were on the green side of things, so the post-concept projects, what kind of demand would they or could they actually create? So there's always uncertainty around timelines, but a kind of total addressable market of what I see in front of me, what could they create? And what our assessment has shown is that there is a real opportunity here. There are things that need to go in the ground, but relative to where the market currently stands, so let's say compared to EPC spend on the subsea side of things, that's very small. So we're looking at something like 3% over the next 5 years or so could only really be represented from the CCS market relative to subsea spend globally, in the region, excuse me. And for rig demand, it's representative more like 1%. So these are very small numbers compared to what you would typically expect to be driving your rig market or your subsea market. The difference, of course, is this is going to be high value where it does happen, and it's not going to be everywhere all the time. So the people who are getting early are the ones who are going to get the opportunities. So this is about positioning yourself to be able to take advantage of that opportunity. Okay. One of the other things I haven't really fleshed out much here, but we're seeing is happening in Europe already, certainly with the Northern Lights project, and is going to be fundamental to this part of the region because of the disconnect between emissions and storage, is the transportation of CO2 via vessels as well. So there have been 2 already on order for the Northern Lights project, and the third one is, I think it's just been ordered, in fact, so 2 under construction, excuse me, and 1 already being ordered. question is, what's the opportunity here? We've got much further distances to go if you really want to go all the way from Japan to Australia. How good, how sensible is that business model relative to maybe going from the Netherlands to Norway, which is a much shorter distance, is a big question here, but at the same time, it's a big opportunity. Certainly from a regulatory perspective, those things used to be an issue, but they're much more solvable nowadays. The question is it commercial? But that's another issue to think about. So I was just going to spend 15 minutes talking about this, so I think I have just about taken 15 minutes, and I didn't want to take much more to allow my colleagues to also give you more detail around some of these areas. It was just to give you a sense of there is an opportunity out there, as Tom's saying. This is about having an understanding of the opportunity set, but also the market dynamics around each of those different areas, so you can fully understand how to enter that market, how to take advantage of that, and where that market, what's the timeline of this market's going to be. Thank you. My colleague Ruth Chen, come up.
Hello everyone, my name is Ruth Chen and I'm a senior analyst currently focusing on APAC offshore wind at Westwood. So I thought we'll just begin with going through what has happened most recently during this year, 2023 in review. 2022 ended with a capacity of 63 gigawatts, and so far in the 9 months of 2023, 1.8 gigawatts of capacity has been added. It's interesting to note that 94% of this capacity actually came from Asia. So from projects such as Akita Noshiro Akita Port in Japan, Formosa 2 in Taiwan, as well as Pingtan Waihai in mainland China. Also interesting to note is that several floating wind projects came online during this 9 months. This includes the Norway's Hywind Tampen, Sinop's Guanlan, and CSSC Fuyao floating demo in mainland China. Now, some of the key highlights, I believe David has mentioned some of the projects that have been delayed, so I guess it's considered a low in the 9 months of this year. But there were highs in this 9 months as well, which is we saw that Germany's leasing round in July, where 7 gigawatts was awarded. Interesting that BP won 4 gigawatts at a bidding price of 7 billion. TotalEnergies won 3 gigawatts at 6 billion. Of course, as mentioned, during this 9 months, the Hywind Tampen, the largest commercial floating wind, came online and is expected to cover approximately 35% of the annual electricity needed at 5 oil and gas platforms in offshore Norway. Something worth noting as well is that the Guangdong province in mainland China has issued several leasing rounds with a total capacity of around 23 gigawatts up for grabs. The lease areas offered includes 7 gigawatts in provincial waters and 15 gigawatts in national waters. The 7 gigawatts in provincial waters was actually just awarded last week, so we are anticipating the 15 gigawatts to come up next. Some highlights of the quarter that has just passed us, the third quarter. The UK's 5th contract for difference allocation round was awarded 0 offshore wind capacity, which is a big difference from last year's 7 gigawatts. So I guess the deterrent for many developers this year was the lower maximum bid price of £44 per megawatt hour, as opposed to last year's 46 megawatt per hour. Also, during this quarter, we heard some big news. Canadian Northland Power has secured FIDs for the Baltic Power and Hai Long projects, both slated to be online in 2026 and 2027. And also in this quarter, we heard that India has launched its first ever 4 gigawatts auction tender for leasing sites in Tamil Nadu, with bids to be issued in early 2024. This is a significant first step for the country, which has an ambitious target of 30 gigawatts online by 2030. So now let's just examine one of the key themes in offshore wind, cost inflation, which was mentioned by David earlier as a factor for project delays that we have heard recently. Cost inflation and its effects have become an important topic in the offshore wind sector, and Westwood has recently undertook a cost inflation market study in the first half of this year, engaging directly with industry. We have released a white paper which presents our findings and analysis, which I'll share with you shortly. The vast majority of respondents in the survey indicated that cost inflation in the offshore wind industry has had a detrimental effect on their business. Most of the respondents have indicated that they have seen cost inflation of 11 to 20% since 2021, with a small number indicating cost increases north of 30%. Nearly 3/4 of our respondents have indicated that they have begun to review the project viability in light of recent cost increases, and over 90% have indicated that decision-making has slowed as a result. So delayed investment, price increase, and renegotiation of existing contracts have been reported. So finally, we have updated our internal models to reflect our new insights into offshore wind cost inflation. This has resulted in an increase in expected offshore wind capex due to higher project costs, and we estimate that an additional 280 billion in capex for the offshore wind industry is due to cost inflation. Now let's take a look at the global capacity outlook and targets. So during this quarter, about 590 megawatts of capacity was brought online, with 20% of this capacity coming from mainland China and 80% from the rest of the world. The 2030 installed base is currently estimated at 333 gigawatts, and we are currently at 19% or 65 gigawatts of installed capacity. We have revised the 2030 installed base forecast due to several projects being delayed. Now let's take a look at floating wind. Westwood has revised down its 2030 floating wind operational capacity forecast from 16 gigawatts to 7.5 gigawatts. We forecast that commercial scale projects will only come online from 2030 onwards. On average, an offshore wind farm takes about 7 to 10 years to become operational from the date of the lease award. The downward revision has been based on this time frame, coupled with permitting and grid connection issues, as well as specific floating wind requirements, such as the port infrastructure, O&M strategies, as well as the development of commercial-scale floating wind technologies. We have also done some major revisions for countries such as Spain and Italy. Spain is aiming to have 3 gigawatts of floating capacity by 2030. However, there are permitting procedures, and the fact that they do not have an auction model have yet to be established. Italy does not currently also have a centralized system, so the project approvals need to be submitted to various agencies, adding further red tape to the projects. Now let's take a look at the global leasing outlook for the period of 2020 to 2025. The global pipeline is set to continue to rise, with significant capacity set to be awarded via lease auctions over the next few years. 2022 was a huge year for global offshore wind lease awards, and 2023 is expected to be slightly higher than 2022. As it is, 32 gigawatts have already been awarded this year, and a further 24 gigawatts is expected to be awarded by the end of this year. Over 21 gigawatts is expected to be awarded in the APAC region by the end of this year, and 90% of this capacity is attributed to mainland China. As I mentioned earlier, 7 gigawatts of leases have just been awarded in Guangdong, just last week. Over 2.6 gigawatts is also anticipated to be awarded in the Americas, and this is attributed to the Oregon lease auction, which comprises of 2 floating wind sites. 2024 lease awards are expected to be lower than 2023, with over 49 gigawatts to be awarded, and 2025 will see a further reduction with over 32 gigawatts anticipated to be awarded. Now, over the next 2 years, the European leases that are expected to be awarded in established markets, such as the UK via the Celtic Sea floating wind auction, the Netherlands, the IJmuiden sites, as well as the Belgium's Princess Elizabeth zone. Some of the newer European markets, such as Portugal and Lithuania, are also expected to award leases in 2024 and 2025. The APAC region will also see leases being awarded in both established and new markets over the next 2 years. So this includes Taiwan's Round 3 Phase 2 auction, which is set for 2024, Phase 3 in 2025, and we are also anticipating leases to be awarded in new markets such as India and Australia. Now let's take a closer look at 2030 APAC capacity outlook and targets. APAC is estimated to reach 158 gigawatts of total installed capacity by 2030, and we're currently at 26% of this forecast. The next chart shows the percentage likelihood of achieving targets based on their estimated installed capacity in 2030, as well as the targets that these countries have set for themselves. Notice that Japan, South Korea, Vietnam, and Taiwan have an above 50% likelihood of achieving their targets. India has recently started a 4 gigawatts auction with bids expected in 2024. However, they are unlikely to reach their ambitious goal of 30 gigawatts by 2030. Now let's take a look at the APAC EPCI expenditure patterns. Utilizing a bottom-up approach and combining wind farm component expenditure, 164 billion of APAC offshore EPCI expenditure is projected over the period of 2023 to 2027. In terms of global projected spend, Europe will account for 49%, making a total of almost half of global expenditure during this period, and this is followed closely by Asia with 32%. In terms of APAC offshore wind EPCI expenditure by infrastructure type, turbines account for the highest with 53%, followed by turbine foundations at 24% and cables at 14%. Now let's take a closer look at mainland China, which is also the world's biggest offshore wind market. Mainland China continues its offshore wind growth despite the expiry of central government subsidies at the end of 2021. 4 provinces to date have published comprehensive subsidies, which includes Guangdong, Shandong, Zhejiang, and Shanghai. Looking at the 3-year moving average for expenditure, China is expected to peak in 2026 with the help of regional subsidies, but will start to decline after these subsidies also end around 2026. In the second quarter of this year, Westwood revised its modeled costs based on a cost inflation market survey, which I mentioned. As a result, we have reduced capex values in mainland China by 30%. Some of the key projects expected to be online in the next 5 years includes the Jiangpu Liuao Phase 2 in Fujian Province, which is under construction currently, and it's also where another Goldwind 16 megawatt turbine will be installed shortly. There's also another significant project known as Qingzhou 4 in Guangdong, which will also have one 16.6 megawatts floating wind project installed around the same location utilizing the NESI 2 design. Now let's take a look at rest of APAC, as well as the promising market opportunity to 2030. Some of the key highlights or key figures: total installed offshore wind capacity is 2.5 gigawatts, including intertidal projects in Vietnam. Excluding intertidal, we are just under 1 gigawatts of installed capacity. The compound annual growth rate between 2023 and 2030 is 28%, and supporting figures include the 244 billion of capex to be sanctioned during this period, as well as the fact that 18% of global capacity pipeline will come from rest of APAC. In terms of operational capacity, the top 6 APAC offshore wind equity stakeholders are shown on the screen. But this is set to change by the end of this year, as projects such as CIP's Changfang Xidao, as well as Green Power Investment Corporation's Ishikari Bay project in Japan, are all expected to be operational. Now let's take a closer look at the rest of APAC. Looking at the 3-year moving average, the EPCI expenditure is on a gradual rise up to 2030, which is very different from mainland China's chart, which shows policy shifts having impact on EPCI expenditure. Some of the key highlights in the region: Taiwan Round 3 Phase 1 administrative contracts were concluded in August, with 2.34 gigawatts being awarded. The lease capacity, which has not been taken up in Phase 1, is about 665 megawatts, will be offered in Phase 2. The Energy Administration recently held a briefing detailing the Phase 2 selection rules and is expected to publish the official selection rules shortly after getting feedback from developers. Also, in the course of this year, we witnessed South Korea, Japan, and Taiwan launching homemade wind turbine installation vessels. This includes the Blue Wind from Japan, which is working on the Naizen wind farm, followed by the Ishikari Bay Port project. We have the Hyundai Frontier, which was delivered from South Korea, and it will be used to install turbines at the Jeju Halim project. And lastly, we have the Green Jade, which was delivered from CSBC in Taiwan, and it's working on the Zhongnan project. Up-and-coming countries with huge pipelines include Australia and the Philippines. However, we currently expect them to commence significant investment activity beyond 2030. Now, this is a snapshot of the APAC turbine market, which shows the top 10 turbine manufacturers, as well as the number of turbines that have been ordered to date in APAC outside mainland China. Notice the top 3 turbine manufacturers are in line with global standings, with Siemens Gamesa, Vestas, and GE in that order. This is closely followed by the Chinese turbine manufacturers, Goldwind and Mingyang Smart Energy, which have supplied mostly to Vietnam projects to date. This comprises about 16% of the turbine market, and it brings us to the topic of the rise of Chinese manufacturers within the APAC region. While they are definitely cost competitive, there are certainly some geopolitical reasons against the rise, but cost inflation is also an issue that's plaguing the industry, including APAC as well. Now, also in this chart is the average turbine rating of the various turbine manufacturers, with Siemens Gamesa having an average of 8 megawatt turbines ordered in this region to date. The APAC average turbine rating remains at 5 megawatts, and this is mainly due to the lower turbine ratings in intertidal Vietnam projects, but this is set to increase shortly with projects in Taiwan, South Korea, and Japan utilizing larger turbine ratings. So some concluding remarks for the offshore wind section. The first 9 months of 2023 has had its highs and lows, but the growth of the global offshore wind market remains on track. Westwood has adjusted the 2030 floating wind installed capacity to 7.5 gigawatts in view of project delays announced. APAC EPCI expenditure will contribute 32% to global expenditure in the 5-year outlook between 2023 and 2027, with expenditure increasing steadily from countries like Japan, South Korea, and Taiwan in the rest of APAC outside mainland China. Some upcoming events to watch out for are the Taiwan's Round 3 Phase 2 auction round, India's first ever 4 gigawatts auction, as well as the Celtic Sea leasing round in the UK. So that's all I have for offshore wind section.
Just before we go to coffee break, Ruth, I think there's one question that's come in that you can probably answer on the hoof. For the leasing outlook, what offshore assets would those be referring to? It's back to your leasing slide, I believe.
So the leasing outlook is essentially a compilation of all the lease awards that we are anticipating in the various regions. So, for instance, the leasing round in Taiwan that has just concluded. So those are the leasing sites which you will be included in the awarded section, the blue model, representing the awarded leases in APAC. So we have leases that are coming up, like the Celtic Sea leasing round, which would fall under the planned Europe section. So these are some of the leasing rounds that we are monitoring. Developers are, of course, monitoring this as well to basically see what other developers are doing. We saw that in Germany, the leasing awards, where BP and Total Energies have invested heavily in Germany as part of their net zero strategy. So this is some of the projects that we are monitoring. I hope that answers your question.
I think it's come through as anonymous, so if anyone wants to grab Ruth at coffee break, you can go into that in a bit more detail. Thank you, Ruth. So we are going to take a short break back in the room at 3 o'clock. Coffees are where they were earlier, toilets are just around the corner. And we'll back this afternoon with, or after break, with marine rigs and Q&A. Thank you. Just a reminder, ladies and gentlemen, the feedback form is on the table. If you could take a couple of minutes before the end of today, it'd be much appreciated. And if you do have any questions, you can use the QR code, or indeed just wait for the panel session and we can come to you. Right, Chenwei, over to you.
All right, thanks, Gareth. Ladies and gentlemen, distinguished guests and colleagues, welcome back. Hope someone tried the iced lemon tea, because it's pretty good. I would like to thank again for everyone to take the valuable time off your busy schedule to join us today at the event. My name is Chenwei, and I'll be presenting the market roundup for the global offshore marine services. So, as Tom has pointed out earlier in the presentations today, the macro environment for the industry has undergone a significant and positive transformation in recent years. And beyond the remarkable increase in activities within the oil and gas market, we are also seeing a very diverse requirements emerging from the wind energy, infrastructure, as well as a civil defense sector. So these diverse sources of demand has laid a robust foundation for the sustained market growth over the next 5 to 10 years. And today, I'll be presenting on the overview of the global offshore marine fleet, the APAC fleet focus, as well as a summary of other supporting assets across various sectors. So given the pretext of a very robust demand dynamics, I would like to shift the focus towards the fleet evolution that has come all the way from 2014. Now we are observing a significant decrease in the number of laid-out vessels as presented on the top left chart. And you can see that in the recent quarters, the level of laid-out vessels has decreased drastically. And the good news is that there is no accompanying level of scrapping activities, which means that these vessels has actually gone back into the market to service the market. And on the right-hand side, you can see that the secondary market has experienced a very drastic surge in activity with a remarkable year-on-year increase in transactions. And in the OSV market, it is a inherently commoditized market, and consolidation within specific asset class is crucial to establish a competitive advantage and pricing power. And upon a greater analysis of these transactions that has occurred over the years, it's evident that key players are focusing on consolidations within more profitable segments, such as the 4 to 8K AHTS, as well as the 2 to 4K PSV segments. And additionally, some of the vessels are also repurposed and being converted to serve other markets. However, this increase in capacity acquisition has resulted in escalation of prices. Now, asset pricing has actually more than doubled from 2021 in some categories, depends on the vessel specification and the age of the assets. The intense competition for available capacity, combined with the asset owner's reluctance to engage in sales activity due to an anticipated market upturn and the departure of the distressed players, has led to a rapidly shrinking pool of assets among the desired specifications. Now let's take a look at the number of deliveries that has occurred over the past quarters. As you can see, that the level of deliveries has dropped drastically since 2013, and you have a period of lull over the 2018 to 2021 period. But in the recent years, the dynamics of this activity has changed quite a bit. And please note that figures beyond 2023 is just for illustrative purposes. Nobody ordered that much yet. Global vessel deliveries have indeed been on the rise in recent quarters. However, it's also crucial to highlight that the low level of new orders that's been placed since 2014. To illustrate this point, consider an example of Bourbon Explorer 520. So this vessel has remained in the shipyards since it's built in 2014 and only awakened from a decade-long slumber this quarter. And this scenario is not unique because there's several other partially completed vessels have also been reactivated. So this resurgence is driven by the urgent need to meet capacity requirements in the industry. And amidst the growth in demand, we have seen since last year when players starting grabbing existing vessels of their desired specifications from abundant pool of candidates to awakening sleeping beauties, as you can see from the number of laid-out decrease in the number of laid-out vessels, and summoning of zombie vessels from beyond the grave today. It becomes evident that new building is essential right at this moment of the industry. However, what are the key challenges faced by vessel owners at this moment to secure new tonnages? And as you can see from the right-hand side, a big piece of the puzzle will be the shipbuilding, which is the capacity of the shipyards. From the shipyard perspective, the past 18 to 24 months, we have seen a boom in new ship orders, mainly targeted at high-margin units such as container ships, as well as LPG carriers. And we have seen a record 163 new LNG carriers being ordered in 2022 as consumers look to secure gas flows amid the supply volatility. And the Chinese yachts, despite seeing a very great reduction in capacity, are capturing the increasing share of LNG order book with 30% of the awards this year. And apart from that, with regards to offshore energy vessels, there has also been a new wave of orders in Asia and Europe to support the offshore wind industries. So assets such as WTIVs, heavy lifts, and of course, SOVs. These orders are being prioritized given their strategic importance to the shipyards, either in establishing the technical credentials, getting their ESG recognition, as well as supporting the development of the local industry. And based on our order book, there are currently 140 offshore wind-related vessels under construction or LOI options across Asia and Europe. Now, we are unlikely to see the same level of new orders over the 2010 and 14 period. Right, the absence of state fundings, favorable payment terms, as well as constrained capacities have placed a natural limit on the extent of which the new building activities could occur. And currently, the delivery timeline for newly ordered OSV is estimated to be in the range of 24 to 30 months. And if you were to place an order now, there is a possibility, however, that the shipyard capacity could free up earlier, especially on the backlogs of LNG or container ship orders when they are being cleared. And there's a major hurdle in the 21-22 period, which is the steel prices, and that has been normalized over the course of 2023, which could also mean a lower shipbuilding cost. And now we are to look at from the vessel owner's perspective. From the oil and gas focused ship owner, even if they were able to attract the necessary capitals to initiate a new build project, there are still significant hurdles to be overcome. And perhaps largest of it all is the uncertainty around what specifications will be required to future-proof these assets that we're likely looking at 20 to 25 years of operations. We have to make crucial decisions over low emission fuel choices and what type of design that were accustomed to the diversibility as well as the adaptability across the various markets. So these rather non-mission critical additions can add to the capex and severely impact the project economics. And there may also be instances where it perhaps makes sense to consider assets with a shorter design life. We are also seeing great external factors, and we have seen the increased momentum of energy transition and ESG considerations creating uncertainty and resistance for new oil and gas focused new builds at almost all stakeholder levels. And the reopening of the global economy after the pandemic has led to a rampant inflation across many commodity markets. Labor inflation is also adding a significant cost, not only to new building, but also to ongoing operational costs. So these are the kind of major factors that we are looking at when we are considering the options of new building. And nevertheless, the industry is currently embracing a more rational approach towards new building, and it has been gaining momentum in certain parts of the world, and it should be encouraged. This involves establishing long-term contracts with T&Cs favorable, as well as close collaborations with operators to gain insights into their upcoming requirements, ensure that the constructed assets are purpose-built to meet these needs. And although we have seen such instances in the GCC, it has yet to be seen replicated in other markets. Another key point dealing with the existing pool of assets is the optimization of efficiency. Optimizing existing assets, adopting technology, exploring new operational models, and fostering partnerships are key to effective utilize existing assets across the regions as well as across the sectors. Vessel operators should embrace technology to enhance operational efficiency through real-time data management tools, considering innovative models such as the hub and spoke system for offshore supply runs, minimizing downtime and environmental impact, or even strategic partnerships between operators, vessel owners, and across global regional stakeholders can also lead to cost reduction and improvement in utilization through the sharing of resources. And with the demand backdrop as well as what we have gone through in terms of supply feed, the overall global utilization, effective utilization is estimated at 73% and is projected to increase to 79%. And in terms of OSV demand, is expected to increase by 20% over the 23 to 27 period. And of course, as you can see from this picture, a concerning point is that over the next 2 years, there's an estimated 650 vessels exceeding the age of 50 years. And although we have seen operators loosening age restrictions in certain markets, this could essentially serve as a temporary stopgap measures for vessel owners to rejuvenate their fleet. And given the limited order book, this implies that the premium fleet is poised to shrink significantly in the coming years, unless a substantial number of new orders are being placed. Now, with that global picture in mind, let's take a look at activities closer to home. While the APAC fleet is supported by a very healthy level of activities driven by upstream developments offshore Malaysia, Indonesia, and Thailand. And noteworthy projects include Kinabalu Field offshore East Malaysia and conventional gas ventures like Tantawan in Thailand. And just recently, ENI has also sanctioned a major gas development offshore Indonesia. We are also seeing interesting use of OSVs offshore Taiwan. There is increasing demand for OSVs with higher bollard pools as well as deck capacities to support offshore wind developments. And in Australia, the sanctioning of Julimar Field, along with two other key developments, will be likely keeping the level of activities high. And it's worth noting that despite such a high requirement, there are almost close to 20 vessels that have actually left the region over the past few quarters to serve the GCC as well as the African market over the last quarters. And if we shift the picture towards the day rates, we can see that the developments actually aligns with the day rate perspective. Although the Asia-Pacific regional rates has seen a notable increase of 33 to 40% since 2020, it is also important to note that these rates are considerably lower from the peak levels observed in 13 and 14 levels, and as they are trailing behind the growth in some of the other regional markets. While the pricing power has essentially returned to the hands of the vessel owners, it is also key to consider factors such as the increasing costs that these players have actually assumed over the past decades. Despite the growth in day rates, headwinds to pricing could include owners that are accepting unfavorable terms as they seek improvement in existing debt structure, offshore overall project price escalation, contributing to cancellation or even pushback of projects. These are the factors that will likely put downward pressure towards the day rates ahead. And as we look at the wider offshore energy support service landscape, demand is expected to increase by 28%, driven by a combination of demands from oil and gas construction, decommissioning, the power industry, offshore wind, as well as the new energies. Some notable asset class we have listed here include the CSOVs, geophysical and geotechnical vessels, as well as cable-lay vessels. In addition to the oil and gas market, we are witnessing a rising demand from the offshore wind sectors for support services, and dedicated COV requirements is expected to reach 280 units by 2027. And the majority of the order book in the European and Asia shipyards now are largely associated with these vessels. This growth is particularly notable in the need for dedicated CSOVs, first, to replenish the walk-to-work vessels that have transitioned out of the market, as well as the increasing number of projects expected to commission and expanding installations base in the offshore wind sector over the next decade. And as you can see, for geophysical and geotechnical vessels, these will all be playing a crucial role in conducting extensive site characterizations and overseeing construction inspections of offshore wind farms. And it's anticipated that the market for these vessels will experience significant expansion in the upcoming 5 years, primarily propelled by the activities in US and Europe. And looking further into the future, Asia and other regions will emerge as a key driver for growth as the more established Western market begin to mature. And the cable lay vessel market is forecasted to undergo a remarkable 13% CAGR growth over the next 5 years, primarily due to the offshore wind and utility sectors. Now, these vessels will be essential for a variety of installation tasks, such as the laying of array cables that connects wind turbine generators to substations, establishing offshore wind connection to the onshore power grid through export cables, as well as interconnecting power cables amongst countries. However, one key thing to note for all players in this industry is that as the landscape requirements begin to look more and more diverse, the understanding of the commercial challenges and the nuances across sectors will be crucial in navigating this diverse landscape. And with that comes to the end of my presentation. Thank you.
Right, good afternoon, everyone. My name is Paul Ezekiel. I'm the rig guy. And first and foremost, I'd like to welcome the guys from the IADC meeting. I know it's been a long day for you guys from morning, so we'll try to make this as interesting, but short as well. Right, so we'll start with the global outlook, right? That's always a good place to start. And kind of the outline for the day is the global and APAC overview, impact of cost inflation, rig moves in a tight market, right? The APAC market outlook, and finally some closing remarks. So, global recovery. There is no doubt there is a global recovery, okay? More rigs are working. Okay, the increase in yearly average contract duration, that's always a big indicator. Contracts are getting longer, right? 47% increase, 11% increase in marketed utilization, 58% increase in the annual average leading edge rates. Day rates have gone up. This one's an interesting. Attrition has fallen very, very sharply, right? By negative 92. In fact, this year, we think there's been 3 attritions. And 47 rigs undergoing reactivation that have been reactivated. So the leading edge day rates, right, as we said, they only include new mutually agreed rates, right? For the jackups, it's by 38%, semis 74%, and drill ships 75%. 25 rigs were removed from the active fleet from January to August 2021, and only 3 this year, right? The other big push is demand for energy. That's not slowing down just yet. On to global rig availability and utilization. Utilization has increased for all types of rigs, as we mentioned. So in this chart, floaters, we refer to drill ships and semis only. Drill ship utilization is up to 96, which is a 45% improvement since the low point of November 21-7. If you can remember that far back to Tom's presentation, he actually highlighted November 2017 as one of the points where things went south, right? Or was his worst point. Semi-subs have had a 28% increase, and jackups increased by 30% since that low point. Jackup numbers have been driven by the exodus of the units to the Middle East. Last year, when we met about a year ago, the main theme was all these rigs moving to the Middle East. That's kind of slowed down for now. And between end 2020 and now, 24 jackups have been retired, right? Tender assist rigs are virtually fully booked. And we'll touch on that in a little bit. Now we go to new builds and attritions, right? Only 3 retirements, as we mentioned. In 2020, there were 49 retirements, and last year there were 42. In this region, the potential candidates for recycling, we'd say, would be the Ocean Monarch, the Ocean Onyx, possibly the West Prospero, right? Jackups-wise, from Keppel, all have been delivered except for one, the TS Jasper. There are 3 contracted drill ships, new builds, Stena Evolution, Zonda, and Deepwater Aquila, but sadly they're all bound for outside the area. Right? 2 remaining jackups in the yard, the Vale and the Var, right? And Bohr has accelerated the delivery of these rigs. That indicates their confidence in the market. Right? There are 2 tender assists in China and 1 in Singapore. There are 2 semis here in Singapore, the Nordic Spring and the Winter, and it's a questionable about what's going on with those rigs. Now we get to the APAC offshore review itself. Market is tight, and you can expect rigs to leave the region if operators do not move quickly. So that's one of the downside of this area. Procurement teams, contracting takes a very, very long time. So the current total fleet consists of 40 jackups. This excludes the NOCs in Vietnam. Now, with regards to the jackups, everything that has a full crew is fully committed, right? Only one remaining outbound for the Middle East, the Al Sadiyat, or unless she's left already. I think she's still at the yard. Charles? We have 1 jackup entering and 1 jackup leaving. We'll talk about that a little bit later in detail. And we talked about the new constructions as well. There are no cold stack tender rigs, okay? There were some that were being stacked. We'll talk about that a little bit more in detail, but they've also got jobs, okay? The situation in Myanmar, unfortunately, remains the same. Myanmar has actually the potential to take 1 or 2 floaters, always been, but, you know, things are what they are. So we talked about the cold stack fleet, right? There are 17 tender assists, none cold stacked, as we mentioned. 4 inland barges, which, to be honest, nobody really pays attention too much. One of them is cold stacked. 3 jackups under construction, 1 drill ship, 2 semis, and the TAR, which we talked about. In our region, there was a total of 46 contract awards between January and October 23, this right up to now. Last year, there were 62. So that kind of ties in with what we had mentioned about longer-term contracts. There is less spot activity, right? People are signing up the rigs for a longer term. Okay, now we'll go into a little bit more detail on the drill ships and the semis for the market here. Now, utilization is slowly increasing, but changes rapidly when one goes on or off hire, especially with the drill ships. There's only 2 around that's working, so when one goes off hire, utilization just drops to 50%. Right now, both are working, right? 3 units, as far as we know, that have MPD, Noble Viking, the Deliverer, and the West Capella. Now, MPD is becoming more and more an important requirement as well, right? 2 semis available, the SSV Catarina and the SR Wildcat remain available. They have been available for some time now. They kind of play in a slightly different market, and so, you know, for whatsoever reason, they've not been able to get work. We have two entries into the APAC region, possibly the West Polaris and the Platinum Explorer after they demob from India. And there are two semis, heavy, harsh environment semis heading to Australia for work next year. The Hakuru 5 seems to have found a home in Malaysia. Cold stacking is very costly to reactivate, right? Warm stacking is very expensive because you keep your crews. So which do you do, right? You're kind of caught between a rock and a hard place. Slow tendering process, as we talked about. Now, the upside of things is that ENI's recent discovery may just be the trigger for an additional unit, right? Now, another one is actually in the Andaman Sea, right? The Mubadala is about to start drilling there, but last year, and it was not mentioned, Harbour made a discovery at the Timpan 1X well as well. So I'm fairly confident that Indonesia will require an additional, possibly two. It really depends on, you know, how fast they can move on these things, right? Now, again, Tom mentioned at the earlier bit that, you know, if only operators can offer 10-year contracts. Total has done that. Total is offering 10-year contracts for drill ships in West Africa, right? And they're funding it as well. So they've come to the realization that the contractors cannot do it on their own. Right? Otherwise, the contractors are just going to keep pushing and pushing, so which is only natural. So Total have already mooted this idea. I believe there's a tender going on for that. Now on to jackups and tender assist barges. As we mentioned, 100%, right? Now, 100% is the marketed fleet. Now that is really quite an achievement, you know, when all the rigs are working, okay? And that'll take into effect, again, once the Hack 11 starts her job at the end of the month. There are still gaps, unfortunately, between drilling programs, right? For whatsoever reason, right? The Naga 3 came off hire and she didn't do any work for about 5 months, right? After PTT canceled its last well. The Valaris 107, she had to wait for about a month in Melbourne for the heavy lift before being moved. Couple of just little nuances. Last year we talked about a mystery rig called the Explorer 1. It never showed up. Right? Everybody, it was even written into slated as going to work in Sarawak. It never showed up. Right? E-Drill purchased the T1516 Vencedor from Seadrill, and they will be reactivating the latter two. They will also see 100% utilization by the end of next year. So right now, it's only the Sapura T9 preservation stacked at Kemaman. So overall, for the jackups and tender barges, it's very, very healthy. Now, the next slide. Costs, right? Now, which of you or whoever of you don't talk about rising costs in our day-to-day livelihood? You must be living somewhere else, I don't know, right? But costs are rising, right? So just some very, very rough figures. So in ASEAN, for example, you know, the average inflation was 7.77, right? Travels and airfares increased. Forecast for this year was 48.5, right? Now, something to consider about costs, especially in the offshore world. Costs to remote locations are far more expensive, right? And, you know, chances are these rigs are working in remote locations. So you need to charter a flight or you know, arrange certain things. Hotels as well. Now, it's only natural that they're going to push up the costs. Now, crew costs, I think from speaking to, you know, some of the contacts around, they have gone up by an average of 30 to 40% since 2020. Some even more, depending on the ranks, right? So each company will have its own way of managing. However, I feel that the bigger ones like Transocean, Noble, Valaris, Bor, because of the economies of scale, will benefit. Right? They have the capability to retain these crew, provide some reassurance, boys, that there's jobs, right, with these long-term contracts, right? Other reasons why costs are going up, supply chain, right? We've all heard this, things are not coming on time. Even oil companies are talking about it, or especially their long lead items, just not able to get them on time. Authorization and permits, another one, right? Are they able to get it? I was reading a market survey yesterday, and it actually made reference to how soon can you get your permits. Operators are asking this question. That means they themselves don't even know, right? Environmental plans. We've all heard about Australia now struggling with this problem as well. Although the environmental plan has been approved, local, for choice of better words, nationals come back there and say they've not been consulted, and so the court throws it out, right? So all these add to the costs. So it's not only cost on the contractor side, it's across the board. So how do we manage it? But the disparity lies in the fact that when one announces huge profits and the other doesn't. So is it fair or not? I don't know. Right? Now, this is the slide that you all want to see, I guess. Day rates. Right. This is probably the most important slide. Okay, so we'll start with the jackups. Recent fixture for a 350-foot jackup going into Thailand, 168,000, starting not too far from now, right? 2 years. Now, some ask the question, why did the company, PTTEP, pay this amount? Well, in my opinion, they did it because they realized, one, it was a rig that met all their specifications. Number two, it was available. And they said, let's not waste any more time. Let's get this rig. So the rig is actually moving out of Malaysia and going to Thailand, where Malaysia there's big demand as well. Okay. The two lower ones, 151851 and 149, also set by the same company. I'll let you decide who that champion is. For the Southeast Asia floaters, right? Now, these are the drill ship rates currently. I'll start with the one at the bottom, 379. That's actually the Noble Deliverer. It should be on the Australian side, but that's an old contract, and they recently renewed it at that rate. But the other two are the drill ship rates which we're seeing, one in Malaysia and one in Indonesia. For the Australia floater market, that's being driven by the two new semis that are coming in, one later this year and the other one in Q1. So just to give you an indication of how the rates have gone up, the drill ship Capella that's working in Indonesia, her previous well was 199. Her next rate is 344. That's how much you can ask for it, right? The Viking is starting in Shell, and this is public information, so that's why hence we're telling you that. Shell Sarawak starting with 408, and then the next one goes to 446. There was the departure of the KG2. She left for Brazil earlier this year at a rate of about 431,000 a day. So the rigs move around to wherever the work is and whoever picks them up first. For the tender assists, right, the T15, close to 110 for a 3-year contract in Thailand. So we can safely assume that the T16 and the Vencedor would be same, if not higher, 110, right? Now, just some news that we picked up. Recently in India, right, ONGC bids for the jackups. The bids came in between $90,000 to $100,000. Now here's the thing, these are for rigs with an average age of 41 years. Right? 41-year-old rig getting that amount. Now, some may be tempted to move to that market because the margins are higher, operating costs are lower there. But that's the dynamics of the market. Now, on to contract award activity here. Contract durations are becoming longer and longer. Now, Petronas Charigali has done what we call a deal with the local contractor, and they've signed these rigs under an umbrella contract, right? So under the umbrella contract, they've got rates kind of locked in, right? And they will expire in Q1 2024, right, with an option, right? So earlier this year, Petronas Charigali awarded a mixed bag of contracts for the Naga 2, 3, 4, and 6. Now this kind of begs the question, because they've already got an umbrella contract, but they may not be working. Is it considered full utilization? According to Velesto, no. If you read their reports, they'll tell you that they did not have full utilization. They were contracted, but they were not working and not earning any money. Right. The Vantage rig Sohana, she's got a 2-year contract with Medco starting up right now, I think. Right. Brunei tends to go with longer term contracts. The 2 jackups that are there are on 4-year contracts, and I think there's a tender barge for 10 years as well. Right. Charigali PTTEP have announced 2 awards, 41 wells and 32 wells. Right. I mentioned Myanmar earlier, otherwise Myanmar would take a couple of floaters. So currently in Malaysia, we've got 2 operating floaters, the Noble Viking and the Hakiru 5. Now, apart from the long-term contracts, there will always be short-term drilling programs. Smaller contractors, for example, in Thailand, Northern Gulf, in Malaysia, IPC, Vietnam, there's a whole bunch of them. They always have, 1 or 2 wells to drill. So the question is, how do you fit them in? If you've got a gap, how opportunistic is the contractor going to be? This trend will continue, these long-term contracts, as long as there's not enough supply and high energy prices. All right, next one, rig movements in a tight market. As we talked about, the market is tight, there's not enough, yet rigs are going all over the place. So that's just a quick kind of, well, not quick actually, quite a lot of movements. So let's start with one which I could not understand. ENI mobilized the drill ship from Labuan all the way to Mozambique just to drill 1 well and then brought it all the way back. Let me see, how many miles was that? That's about 13,000 miles, right? Yeah, 13,000 miles. Then, about a year and a half ago, 2 years maybe, Beach Energy brought a rig all the way from the North Sea, all the way to New Zealand on a heavy lift. That was 15,000 miles. Right. Now we've got the other 2 semis coming in. Then there's another jackup coming in, the 247, again from the North Sea to Australia, Singapore to Brazil, China to the North Sea, the Prospector. Here's a good one, New Zealand to Trinidad, all the way around, right? Beach Energy released the rig only to go out and find another rig, right, to bring it from the North Sea. Then there's one here, this one from over here, ENI, they brought a rig down to GB Resources, all the way south, on a heavy lift, and the well took less than 3 weeks, right? So, I mean, the way I look at it is, some planning needs to go into this, right? And think about the fuel that was burnt, right? if we are so concerned about the exhaust and the CO2 that we're emitting, shouldn't that be a consideration for the oil companies when they make these kind of moves? Hey, there's a rig here, let's use it. But who knows? There may be reasons, commercial reasons, availability, whatever. But it just blows the mind, right? So likewise, when the rigs are idle here, I don't see why the oil companies don't pick it up and start drilling a few wells, right? They'd rather wait. All right, now we're almost to the end of it. Outstanding requirements. This is not an exhaustive requirement, and please don't be deceived by the wording here. I know I couldn't find the right words, but 2 jackups for Thailand, that's a recent market survey stroke tender that's come out, right? So all this information is based on recent requests for information, expressions of interest, tenders, and prospects. Right? Malaysia, 9 to 10 jackups, various programs. Right? I'll summarize this all at the end anyway. Vietnam, 6 to 7 potential projects. Indonesia, 3 as far as we can identify. Australia, and Philippines, right? So based on the data that we've had, right, and this is our assumptions, Malaysia will probably need 1 or 2 additional jackups next year. Yes? No, this is not incremental. I'm summarizing the incremental now, right? Malaysia would need 1 to 2 additional jackups, right? They will, of course, try to move their rigs around, the Valesto rigs, Malaysian contractors, move them around, including the tender barges, right? But with the 1 rig leaving for Thailand and another rig leaving for Indonesia, they may not come back. At least the one from Thailand is not coming back. They're going to have to find something else, right? Thailand is also about the same. Vietnam will need at least 1 more unit because there's lots of spot work there, right? Thang Long, Koo Long, all these people, they always have bits and pieces, right? The Petro-Vietnam rigs are currently all outside, or one's moving out as well of Vietnam, hence the need to fill that gap, right? With regards to floaters, right, with the ENI discovery, and we mentioned Geng North 1, potentially 1 more floater, right? Malaysia may look at sharing the Noble Viking with the other operators, basically PTTEP and Petronas Carigali. Now, another rig that's gone missing is the Deep Venture. Last year, I see Arthur laughing there. Last year we talked about it. It never came off the blocks. They were working on it, but it's just gone dead. They were meant to drill by this year, but that's the problem you have with the smaller companies. They just can't afford to get all this reactivation. The reactivation of a rig like that would have cost at least 30 to 40 million, maybe even more. We talked about Lim Bayong earlier, right? Perhaps it may come back if they get a drill ship at the right price, but prices are going up. And so with that, I've got my final slides. So final thoughts are day rates and utilizations for now will continue to rise, okay, at least for the next 18, 24 months. There is a shortage of jackups in Southeast Asia. Something to think about, uncertainties in Australia, right? Delays, severe delays, right? Costs are not coming down, right? So especially on a long-term contract, right? I'm sure there are cost adjustment clauses or inflation clauses placed in your contracts, but that's something that you need to consider. The availability and retention of qualified and competent crew, that's your backbone, right? More and more people are finding it difficult to find these people. There's been a whole, kind of generation of people that have left. Where do you find them? Where do you train them? Or how do you keep them? Finally, just a thought-provoking question. Who will make the first move to order a new rig, right? there are certain reasons why they're not doing it. In fact, our director, Terry Charles, wrote a white paper on it, and it's available if you guys want to read it. It's a fairly interesting read. And with that, I thank you very much.
Thank you very much, Paul. If I could have the other speakers up to the stage, please. Thank you. So we've got just a panel Q&A. I realise we're running a little bit into that, so I'll just ask our Westwood speakers if we can be fairly concise in our answers, that would be appreciated. We have had some questions come through, which I will go through. Emma, can I swap mics with you? If you do have a question from the floor, please raise your hand and Emma will get to you. Right. I think it's probably a good idea if we go back to the beginning, because that's where the first question is coming from. Tom, this is coming over to you. So, get things going. For how long will Saudi Arabia be willing to give up its market share in the oil market? Used to produce 11 million barrels per day, but now only producing 9.
Yep. They seem very committed. I think they've already extended the 9 million cut through into 2024. I think it's always wait and see with Aramco, but the mathematics are pretty straightforward. If you multiply 9 million barrels a day by $55 versus if you multiply 12 million barrels a day by $85, you get a lot more value if they continue to cut realistically. So, it's mathematically makes sense for them to cut. The other thing to bear in mind is that is their greatest resource. They currently have an RP ratio, which is the number of years that they can produce at current production based on 11 years. So based on 11 million barrels a day, that's about 50 years. So 11 million barrels a day, they can produce for another 50 years. They continue to commit to the oil industry. They want to extract every molecule. They want to be the last man standing. So they need to be very careful with that resource, not waste that resource. So when you look at the numbers, at a simple level, I think they will continue to commit. They are more focused on keeping the price at $85 a barrel than the quantum of what they're pumping.
Thanks, Tom. We're going to stay in the region, but change tack slightly. Middle East NOCs have pushed up rig and OSV demand to very high levels, but will demand continue to grow incrementally from here onwards, or will it plateau? Between yourself and Chen Wei, I think. Yeah,
I'll just go first and someone else jump in. The rig count in Saudi, the jackup count is going to unprecedented levels. There's more than 90 jackups there. ADES, who just listed on the Tadawul, they have been extremely hungry. They've purchased everything that's out there. Those are long-term contracts. So we're not talking about 2-3 years and a hump and a spike. We're talking about a sustained level of activity. That's to bring the MSC up to 12 million barrels a day. And they'll need to continue to drill to sustain that production capacity. Of course, it kind of goes in line with the previous question, but this isn't just 2-3 years and then back to kind of previous levels. It has been elevated and has been step changed.
And of course, it will likely apply to the level of vessel activities that we are looking at. Although we expect a slight drop-off in activities post-2028, but that will be supplemented by a lot more long-term IRM contracts, and that will provide a sustainable base of vessel activities going forward.
Thank you, gents. Let's just jump across slightly. David and Ruth, for... This references, I think, the project certainty that you spoke to earlier, but for delayed wind projects, how long ahead do you think they're going to be postponed to, or forever? Which part of the value chain will be most impacted in your our view?
Okay, thanks for the question. Whoever posted that one. It's a difficult one in some respects because obviously no one really wants to cancel everything completely because they still see a lot of value, and the reason they bid for it, they put together their business case at the time, but things have moved around. So essentially people are trying to figure out ways to still make them happen. I mean, as you saw, a large portion of the problem seems to be in the US, where things are significantly changed. And the question you then ask is, well, what can be done about it? Well, let's go and renegotiate maybe our contracts, our PPAs, essentially the revenue that you think you might receive for that. And there was a recent signal in the US that isn't always easy and or possible. So, for example, in New York, the local regulator said no. That's quite a problem then. So that will mean you're going to have to either completely cancel or rethink your project. So the US in particular seems to be an area of risk where you never know, you might get it forever, but I certainly hope you don't. But it's going to have to take some serious rethinking on the projects there. In other parts of the world, you know, so the UK and others where things have been mentioned, it shouldn't necessarily lead to as bigger problems. This is where you can have much more of a negotiation with governments who are extremely keen to see offshore wind a core part of the future. Made a few hiccups along the way, but it's really a process of working through the dynamics and what you can make happen there. I guess the point is, it depends. It's a horrible phrase to use, but it does depend. In terms of the impact, I mean, it is interesting. Essentially in the US, the biggest loser is someone like an Ørsted, essentially, right? I mean, if you think about the impact that's had on them as a business, the impairments they've had to take, the shock that's happened to their share price, etc., that's a pretty bad outcome for them. You know, it's less bad on other developers who maybe have a more diversified portfolio, are less exposed and are positioned slightly differently. So in terms of the impact on the value chain, you could argue it's the developers that are most impacted by this. Of course, that then naturally filters down. So if you're trying to invest in different areas, so let's say in Taiwan or so, where you said, look, I've got a local content rule and suddenly projects are delayed. Well, you know, first of all, you've had to make a local investment that you probably didn't want to have to do because it's probably more expensive and more restrictive. And then secondly, you can't suddenly supply to a market anymore. It becomes a real issue. So it depends on the jurisdiction, but essentially in my mind, it's the developers that are really worst hit initially, and that then filters through depending on where you are and which market.
Thanks, David. And in terms of, sorry, Ruth, go ahead.
I thought I just want to add that, of course, we were mostly talking about fixed bottom projects in the US. So, of course, when you think about floating wind projects, the project uncertainty is even higher because the technology is not yet proven, with just a handful of technology providers being proven. So I guess if you look at this from this perspective, floating wind projects, and we have revised the forecast down to 7.5 gigawatts, and this is really due to the announced project delays by various floating wind developers. So this just to add another perspective towards.
Thanks. Let's stick with wind for the moment. And again, if there are any questions from the floor, please just put your hand up so we can see you, and I'll interrupt the flow. We had a question here from Ramo, thank you. How much emission reduction with wind energy versus fuel energy, and how much the cost?
Okay, yeah, thank you. No, it's a difficult one because
yeah, small question.
I'm going to use it again. It depends. I mean, each project's different, and it depends on if it's fixed bottom or floating wind. What kind of, I'm assuming we're talking about platform or production here, rather than a rig or anything like that, just for clarity. So I'm going to base it on that answer. You know, so it's very interesting. So, for example, I'll use the UK as a local example that I know pretty well. You know, it's quite clear that electrification and using wind will not solve the problem, particularly for older platforms, right? It's an extremely expensive thing to do when you've only have another maybe few years, 5 years, even 10 years of an asset life left. These kind of economics start to make a lot more sense when you have newer assets, which is why sort of West of Shetland, which is sort of the newer development area in the UK, that's where those things are much more considered and sensible. The issue you've got when you start talking about wind specifically is, of course, it's variable energy in that sense. You're not connected to the shore, which is by far the most efficient and cost-effective if you're nearer to the shore way of doing things. And so fuel displacement typically works quite well that way. High wind tampon, which is currently providing about 20% or less power to a couple of Norwegian platforms, that's not going to solve the problem. It's going to provide a marginal impact, and it's definitely not done with profit in mind. It's done essentially with marketing in mind, I would argue, at this stage, right? There are obviously more incentives in different parts of the world to do this. The only way it can realistically work is if there is an incentive in place from day one to say this has to be a core part of how you design and develop things. Or a government has to push it. So there's something called the INTOG round that happened in the UK, where you were given a 50-year lease for your floating wind project, and only 5 years of that lease you actually had to decarbonize an oil and gas asset as part of it, and the rest of the time you could kind of find commercialization options as you wished. So suddenly you've got a 45-year timeline to figure out how to make money on something you're essentially going to lose money on for 5 years. Difficulty is the oil and gas player that you're trying to sell that electricity to willing to pay a premium for that period of time. And that's definitely not sorted yet. None of those projects have taken FID. But it's about being innovative, incentivizing and driving that, because it's definitely not the best way of doing things.
Thanks, David. We're going to jump down to Paul, and then Chenwei and Tom will come back to you after that with a couple more vessel questions. Varun asks, how do you think the SEA and Oceania floater market will be affected when rigs from Brazil come off contracts in the next 4 to 6 years?
Well, the short answer to that is there'll be more rigs available for contractors or operators to choose from. The question is, are there going to be any other markets between then and now that may come up that may take this tonnage? The other is, what about the age of those rigs that needs to be looked at? Would they qualify for work outside of Brazil? So, it's one of those questions where you can't say this is going to happen. It depends, to quote a wise man.
There's a theme coming here. Thanks. So just coming back to OSVs then, Chenwei or Tom, do we see increased profitability on vessel rates in one market impacting availability for the other markets, for those vessels that can work, obviously, multiple markets?
Yes, I'm going to be a bit more
And
definitive. Yeah, you've seen migration. You already have vessel migration. There is an arbitrage that is developing and widening in the OSV sector. There are markets that, despite higher OPEX, are demonstrating a far more rapid and aggressive price increase. Of course, there's local content that needs to be considered, so it's not just a case of rocking up and looking for a contract. There needs to be commercial partnerships forged, but you certainly are seeing, particularly in this part of the world, owners looking a little bit green-eyed at what's happening in Latin America and the Middle East, looking to forge partnerships to move assets into that part of the world. There's been extremely lucrative JVs such as Wabi Valiance, for example. We'd expect to see a bit more of that probably over the next few years.
Thanks, Tom. And sticking with vessels, do we think the OSV day rates to Asia will continue to rise?
I think there will be a certain level of headrooms for growth, but essentially it's not a market whereby it will go on forever. There are still pricing destructive forces in place within the market, such as players trying to improve their capital debt structures. There are also the natural ceiling formed by project developments. And as you can see from the presentation, there's a huge amount of cost escalation that has been happening all around the board. So contribution to that will likely be prohibited at one point. So.
And actually, staying with you, Chenwei, I mean, just looking ahead, what do you think the main considerations are now going to be for vessel owners?
I think the key problem that vessel owners has looked to solve is One part of the puzzle will be the new building. Similar to rigs, everyone is just waiting for to see if someone will take the plunge. We did see some of new orders coming in and new builds, but those are very special circumstances where all stars are aligned. Vessels are getting on 5 to 10 years type of contracts. Those are the essential conditions that you can actually have a rational new building. From the commercial perspective, again, owners have to be beware of the pricing destructions if you are going into a downward spiral of price competition. So contract terms has to be chosen very carefully. Operational-wise, vessel owners will definitely look at ways to improve their efficiency. Of course, the leveraging of available technologies to get real-time tracking to improve your optimization of vessel routes, efficient use of fuels, and you have collaborations across markets so that you can have the price arbitrage between different regional markets. So these are some of the basic considerations that they have ahead.
Great, thanks. I think we'll do a couple more questions as there is more food actually, believe it or not, and it'll be getting a little bit cold. Ruth, just jumping back to wind, and then actually I've got one for everybody here. What's your take on offshore wind suppliers who are looking to expand globally, and I suppose attached to that, one to mix with David, given the current issues that offshore wind is facing, is that going to limit future scale?
So I guess suppliers, the current trend or the thing that is hitting the headlines recently was really about how the Chinese suppliers are trying to gain a headway into the global market. We hear of turbine manufacturers like Mingyang Smart Energy, which is considered one of the more experienced Chinese turbine suppliers when they have a project in Italy by Renesia, the Taranto project, where they supplied the turbines. So they have been very successful so far, and part of the reason why they can pose a challenge is really because in their home market, known turbine bid prices are 35% lower than 2019 levels, and they have managed to bring the cost down, which is opposite to what we see in the rest of the world. But at the same time, we hear about I think just last week, the EU is considering a anti-subsidy probe into Chinese wind turbines. So there's a lot of political undertones against the trend of Chinese suppliers gaining a headway into the international global market. So these are some of the things that are being discussed now, and we would probably just have to see how things move forward. Of course, cost inflation is an issue which cannot be solved over time, and it takes a while before the supply chain adjusts to the situation. So I think this is what I have so far.
I'll just add from a marine contracting perspective, the challenge is you just cannot be regionally generic with your wind strategy in a place like Asia Pacific. You really need to commit to a country market where you're going to play so that you can differentiate and allocate resources properly. And that's the challenge. Which one do you go for? You know, we have these lovely hockey sticks for Japan and South Korea, which is the best market, and really understanding the dynamics at play and what makes sense. You know, one is characterized a little bit more floating, one's a little bit more fixed bottom. What does that mean? And it's really kind of having that really deep understanding and commitment to country-specific markets, I think is the answer. Going to differentiate winners and losers.
Yeah, and that's really maybe one of the challenges for scaling, which was, I guess, the second part of your point there is that it's still a very fragmented, immature market overall, where you have to try and understand all the different rules, try and make long-term bets in an evolving market. And the reality is, of course, it is a very immature and small market, which has prided itself on the idea of reducing costs, same as all the other renewables out there, and being a, initially higher cost, but then a cheaper and cheaper and cheaper energy source. If you compare that to what's been happening with solar or even onshore wind, offshore wind has by far risen the most out of all of those in terms of cost inflation and impact, while solar has pretty much deflated, actually, just a little bit, but has deflated at that time. So there are some unique challenges that the industry is facing, and it isn't the cheap resource for everybody in every region, right? Offshore wind will work really well in some regions and won't work so well in others. So you have to be really careful about that and make that work. So that's the risk to it scaling, the complexity, the challenge, the immaturity. The flip side, of course, though, is that, was it you were saying, Ruth, there was sort of 60 gigawatts or so that's going to be leased out, so auction capacity that's going to be done this year. That's a record, right? And it's not like people aren't going after that capacity. These auctions are well thought after. They are, people are interested in taking part, and they're interested in making this industry scale and grow. And governments are the same. Offshore wind is something you can actually create an industrial strategy around. You can't really create much of an industrial strategy around solar in the same way. Maybe in China you can, but in the rest of the world you simply can't. And so if you're looking to create, jobs, green jobs, you want to have a gigawatt scale renewable industry, really offshore wind is one of your only options that you can do that through. So if you've got a supportive government and you've got, there is enough money in this world to fund these things, if you've got a supportive government, essentially that will help to continue things. So always watch what governments are saying, how much they're supporting and where they're going. If that fades away, the offshore wind industry will really struggle.
Thanks, David. I'm going to stop saying last question because two more have just popped up, so we'll deal with them really quickly. David, one sentence answer, please. And thank you for posting this.
It depends.
What are the opportunities? Sorry, that's the wrong one. Failed offshore wind auction in the UK. Government's misunderstanding of energy price or developers' greed?
So it's interesting because it's an auction for a subsidy rather than auction for a lease. So that's one thing. So the price was essentially set, which is slightly different to you going in and saying, I'm going to get this lease and I'm going to take part in an auction in a competitive manner. This is what you're told you need to achieve. And if you don't achieve that minimum level, you're out. So there is a slight nuance, and that's important, I think, to recognize and understand, because people required a certain price to get there. It's a long sentence, isn't it?
Stop breathing, fine.
Thank you very much. I think the point really is that it's the government completely misunderstanding and misreading what's been going on and simply not listening to industry. It's as simple as that. And the good thing is, eventually they'll start listening again, and it'll be fine.
Thank you very much for that super long sentence. Right, we have one more question which feels quite fitting to finish on, and Tom, this is coming your way. And just while Tom gets his microphone up, just a reminder, please, that the feedback form is on your table. If you 2 minutes to fill those out, please. And if you want any information on any of the products, you can just tick the box and we can get in touch with you. So, Tom, what opportunities and challenges for H2 APAC? There's a lot of support from policymakers, but little apparent investment from the private sector. I'll give you more than one sentence.
Repeat the question.
So there's a lot of opportunities and challenges for H2 and APAC. There's a lot of support from policymakers, but little apparent investment from the private sector.
Do you want to try that first?
From a wind perspective.
You say H2?
Yeah, I think it's second half of the year. But
Second half of the year, okay.
Whoever asked the question, we can clarify whether that's H2 or H2.
I mean, opportunities are abound, I think in this part of the world. We've seen a resurgent exploration market. We've got great momentum in oil and gas. We've seen rig counts, pricing. Everyone's gonna be happy. I think what I was trying to say in my presentation is there are some headwinds that we may be facing commercially, but we're not going to see them for the next 12 to 18 months because everything's locked in, everything's kind of been paid for. So yeah, for the next half of this year and beyond in the short term, I think we're looking good.
Thanks, Tom. I suspect that was hydrogen. So when we break, please grab David and you can speak more about that afterwards. We are going to wrap up there. Thank you very much for sticking with us. We have some more food, some more drink. Welcome to staying here for a bit longer. Speak to the team. We can run some demos of the solutions if you like as well. But thank you very much, and thank you to everyone that spoke today and all the rest of the team. Well done. Thank you.